More than ever, real estate is considered a bellwether for the larger economy. The fact is that home and commercial real estate prices are increasingly, some might say obsessively, watched by market commentators. That's because whether buildings are being constructed, sold, demolished, refurbished, or foreclosed, real estate accounts for an enormous percentage of the economy. Since the residential market imploded a few years ago, bringing the commercial market along with it, economists and prognosticators of all stripes say that the real estate prices, especially on the residential side, are a gauge of how we're doing, economically speaking. So I decided to take a look at a few key real estate securities indexes, RESIs we call them, to see which trends are emerging. Specifically, I wanted to look at the performance of our Dow Jones Select Resi Residential Index. First, I put it up against the Dow Jones Total Stock Market Index, which is a gauge of the broad U.S. stock market, as a benchmark. Look at this chart, which covers the past 3 years. It starts out at the nadir of U.S. stock markets in 2009. Look at how the residential index vastly outdoes the benchmark index. Now, I've read a lot of commentary saying that real estate fell so drastically and so precipitously in the 2 or 3 years before this point that even modest performance drove a lot of smart money into the market, buying up bargains along the way. But the stock market is considered to be in recovery since 2009. And look at how it was outperformed by the residential index. Before you start dreaming of flipping houses like a show on HGTV, let's narrow the scope a bit. This slide is for the past 12 months. The residential index is above the broad market, but it's not nearly as dramatic since the bull market started at the end of last year. There's a definite difference, and it even increased a little at the end of April. Now, I decided to put the residential index up against an index that a lot of people have been talking about lately, and that's self-storage. Take a look. This slide is a 3-year span of the two indexes. You'll notice that the residential index outperforms the self-storage almost the entire period. But now let's turn to the past 12 months, and you'll see why self-storage is on a lot of people's minds. Look how it outperformed the residential index starting around November of 2011. Keep in mind that residential outperformed the broad market in this period, so self-storage did even better than that. The question I had was, why? Why are these two real estate securities indexes doing so well? Well, this is the hard part of any down economy. The massive amount of foreclosures and people just plain downsizing has produced a huge group of Americans who need to store their possessions as they move into smaller residences. That may be why the self-storage companies are doing so well. As for the residential index, it's got a large number of stocks that are in the home rental and manufactured home industries, two groups that also have benefited from all those downgrades and foreclosures. But here's the catch. As the economy has slowly started to improve in 2012, the year-to-date numbers are telling. While the residential index is up 9.8% and the self-storage is up almost 10.8%, the overall stock market index rose 12.2%. So it seems that the tables have turned. Two real estate sectors that outperformed due to a down economy are now being outperformed by the broad market. Longer term, we would expect that real estate would be more in line with the broader market as the economy recovers. Thanks for tuning in. I'm John Crespo for Dow Jones Indexing.